Hello and welcome to a lesson on the sentiment effect. And today we're going to talk about how price engineers sentiment in price to then create liquidity or order flow. So we are specifically going to discuss the sentiment effect for London's trading. How does the market create sentiment with London's price range, and how does the market engineer liquidity in terms of looking for runs in direction of daily order flow? Now, obviously, as always, our sentiment always starts with, for day trades, we always start with building our analysis or our bias with the daily order flow. So we need to define what daily order flow is. We need to define where the general liquidity is for daily time frame. And we need to also define the time of the week, which allows for range expansion. Now, on one of the lessons for the day trading module, I talked about utilizing the previous day's range to identify sentiment for a current trader range. And we're going to talk about that, and also at the same time, we're also going to talk about how price engineers sentiment with the Asian range. Now, when we're looking for executions, we're looking for executions in direction of daily order flow because that usually is the highest probability delivery we can get. And now, you can go into the marketplace and you might want to trade against order flow, which is absolutely possible. You can trade just like TGIF, where you can go in and trade, look for reversal setups against weekly order flow on Thursdays and Fridays. You can also look for reversal setups against daily order flow towards the later portion of the daily range, aka where the market will see a distribution after expansion phase. Okay, you can also do that, but for you to go in and do that efficiently, you need to know what the daily time frame is doing. Without the context of your daily narrative, it will be very or extremely difficult, if not impossible, for you to go in and scalp or day trade very efficiently, trying to trade in direction with order flow and also against order flow. So for day trade, we are utilizing the use of the Asian range and the opening price range. And these are the two key elements that build upon our sentiment effect. So we're more primarily concerned with the delivery price for Asia, and we're also primarily concerned with the delivery price after session open. Not just session open, but after true day open. Now, if you went back to one of the previous lessons, we talked about the time window for each day trading session, and we talked about the Asian range, and we talked about trade day open. And if you remember from that lesson, we talked about trade day open being 12 a.m. midnight New York. So 12 a.m. midnight New York, that's where you get the opening price for the algo, or for IPDA, which is the interbank price delivery algorithm. Now, we're not really concerned with the opening price at 0 GMT. We're more concerned with the opening price at midnight New York and seeing the delivery from Asia, and the market usually uses that to build upon a delivery range for expansion. So just to sum it up, for bullish days, we're looking to buy ideally below Asia's range, below the low of Asian range, and also below the low of 12 a.m. midnight New York. For bearish high time from order flow, looking for bearish executions, we're looking to sell short above Asian's range, or above Asia's consolidation, or above Asia's high, and above 12 a.m. midnight New York. So just to sum it up before I go in depth or in detail into what these means. So we're going to do for bullish executions, we're looking at 12 a.m. Eastern Standard Time, which is midnight New York. So we're looking to buy below 12 a.m. midnight New York, Eastern Standard Time, below Asian range low, and for bearish executions, we're looking to sell above 12 p.m. Eastern Standard Time, and also above Asian range high. So it really is straightforward. We're looking to buy below 12 a.m. midnight New York for bullish executions, and also below the Asian range. And for bearish executions, we're looking to sell above 12 a.m. midnight New York, and also above the high from Asia. Now, the market would have a short-term shift in sentiment, and less informed traders will chase price or the impulse swing or the initial intraday swing, which is what we know as the jitter swing. So what usually happens is that a lot of times, or classically, not even a lot of times, this is majority of times, but classically, price delivery going into London session is usually fickle. So let me change this. Okay, so we classically will have fickle price action going into Asian session, and price will trade fickle. And then as we end Asia and start to go towards London, price will then look to engineer a sentiment in price. And usually price will make an aggressive run against its intended direction. Okay, now remember that the end of Asia is also the start of the 3-day open. So if I go back and I pulled up the PDF from, so let's go and pull up the PDF where we talked about the time windows for each session. You can see Asia starts around 8 a.m. or 8 p.m. and ends around 12 a.m., which also coincides with 3-day open. Now, if we are bullish in price, we want to see a decline below 12 a.m. midnight New York or the end of Asian session. And also we want to see price run below the low from Asia. Now, typically what happens is retail traders who are looking to trade during London session, they wake up and they're looking at the decline lower for London, and they identify the trend as bearish. Meantime, all that was going on was the market was simply being allowed to decline into a discount, and usually it's going to be a lower time frame discount, like a 1 hour discount array or a 15-minute discount array, and then institutions will then step in and accumulate positions, and then the algo will reprice to a level of counterparty liquidity. Classically, this is classic price delivery. So what happens a lot of times is that we have a range in price, and then out of the Asian session and also at the start of 3-day open, the market starts to gradually make a run lower, and then at the start of New York open, or sorry, at the start of London open, the market starts to aggressively, during the first 1 hour to 2 hours of London open, the market will aggressively run for a discount in a predisposed daily bullish order flow. And then when price gets into that discount array, okay, there will be a sudden expansion out of that range as institutions step in a price. And usually you have a shifted structure, sometimes you might not, but once we get below that low there, you have a shifted structure, you have your optimal trend entry, and you have your continuation higher. Now, as the market runs lower, remember there are individuals that go into the market trying to go long at the lows. Now, they don't have the context of what you have, meaning they don't understand the PDA rate that price is seeking for a discount to then reprice for premium or buy sell liquidity. So if retail goes in early and tries to go long here, and then they're stopped out, then try to go early and go long here, and then they're also stopped out again. And then at the same time, individuals who are making profits, right, they're either chasing trend or they're aggressively trading their stops, because they now think the market is bearish because they're seeing lower lows and lower highs and lower lows, because that's obviously market structure. Market structure is lower highs and lower lows and price delivery, so that's what we're looking for. And then as the market gets down into this high time from discount, or again, usually it's going to be an high time from discount, and then inside of that high time from discount, there's going to be a lower time from inefficiency there that the market is actually referencing. Right now, not all the time this is going to be an item from discount, but if it is, that really is a very strong confluence for price displacement. And then you get an impulse pricing, and then you can buy the retracement looking for around higher. So this initial decline to our discount rate is what we call the jitter swing or the false move, which is classic delivery for London. This is jitter swing, and usually what the market does is the market usually will create a range for Asia, and then that range is what the market utilizes to set up sentiment. Okay, so the run lower is actually creating a sentiment of weakness on this asset, and that pulls in liquidity on the buy side because people will want to sell weakness, or they want to sell what I call perceived weakness. Okay, so this is called, I'm going to put in quotation marks, it's called perceived weakness. So retail is selling what they believe is perceived weakness, and all along this is just simply an engineering of sentiment and price, then run the opposing side for buy side liquidity. So what we do is we wait for that jitter swing, and that's for a I odd setup for London session. A I odd setup for London session is a jitter swing with Asia consolidating and they run down into discount, and then a very strong expansion or rally higher, and that is classic sentiment effect for London trading. Okay, so essentially, again, just to repeat, we're looking for a short below Asia's range and also below trade open. Remember what I talked about with the daily range? We're gonna revisit that one more time. Okay, this is trade open, which ends Asian session. The daily range is, you have your opening price, you have your run lower to a discount, you have your profit release phase as the market expands above the open price, and that initial run lower becomes the low of the candles week, and the run to a counterparty liquidity before the market starts to distribute going to end of day is a run up into premium, and then you have the classic daily bullish candle. This is your classic daily bullish candle, all right, where you have the market decline down to discount, and as it starts straight above, you have your profit release phase where the market starts to see tons of expansion with inefficiencies in the process of reaching up into a counterparty liquidity. And once the market gets up there, then distribution occurs and the market closes for the day. Now, classically, you have some opportunities to trade the daily range. You can either go in here looking for day trading to go long, or you can go in here looking for scalps to go short. Now, this is more difficult to pull off versus this one here, which is why generally, as a general rule of thumb, you're aiming to catch the run in direction of order flow, because that's where you're going to see the more the higher risk to reward and the more return for your work. All right, so this opening price is 12 a.m. midnight New York, and institutions will accumulate below that opening price, like we've talked about so many times. The institutions will go in and they will accumulate below the open price, and then the algo will draw the market higher to a level where they can be counterparty liquidity, and then you see distribution coming to the marketplace, and then that's how the market closes for the day. And that logic here with the daily candle or a daily bullish candle is what I just described with the Asian range, trade open, and that jitter swing lower into a discount for higher prices. Now let's define proper conditions for setups looking for buys in a bullish order flow. So we're going to do this as a PowerPoint, and we're going to talk about proper setups for long entries. All right, so when you're bullish in price, what are you scouting for, or what are you hunting in price? Okay, so we're going to start first, and you're looking to be a buyer only if IPDA suggests a daily or a 4R discount array is in play for longs. Okay, again, the backbone of your analysis stems from your daily or 4-hour price delivery. Okay, so if you're looking for buys, then you want to see the market expanding away from a daily or 4-hour discount. Okay, either you want to see the market expanding away from a daily or 4-hour discount, or you want to see the market dropping down into a daily or H4 discount array to start the new delivery cycle, aka bullishness or longs. Okay, but your lower time frame displacement is always going to stem from the daily order flow. Always, never changes. Always going to stem from your daily order flow, and this is why your daily and 4-hour levels are key in your intraday charts, because a lot of times you're going to see real massive displacement. I mean, very quick displacements from those key levels. And when you start to see it so often, you start to get mind blown by the consistency of delivery around these key higher time frame levels. So your IPDA should suggest, a daily or 4-hour discount is in play for longs. And then number two, we need to define that there is sufficient range in pips between the discount where we're expecting the reversal from, or where the market will start the expansion from, to our counterparty liquidity, aka premium, where we're expecting the market to trade up or down into. So meaning, if you're looking to execute on the trade, the risk to reward needs to be favorable. Now, what's a favorable risk to reward for me? I usually use a minimum of a 30-to-1 risk to reward. Meaning, target one must be, or my total trade idea must be at bare minimum a 30-to-1. Okay, and if I'm going to take TP1, I never take TP1 unless it is or I never partial. Not partial is different from taking profit, because different conditions can create different reasons for partial. But I never take first profit until the market is well over 2R. Okay, well over 2R. So for us to go in looking for longs, we need to identify that there is a sufficient range between our discount array and target objective. Once we've defined our discount for daily time frame and also for the 4-hour time frame, and we've also identified that there's sufficient range in price for it to reward our execution, then what we're looking for is we're looking for price to decline under the quote unquote opening price and Asian range low. So we're looking for a price to decline under the open price and also below the Asian range low, which is what creates the sentiment effect. Okay, because if we start to see the run lower below the Asian range, which should ideally be in a consolidation, so that actually brings me to number 4. We want to see the Asian range create a nice consolidation, because that consolidation means any sudden run out of the consolidation quickly triggers something retail, because again, remember, retail, they are impatient, just like you currently. Maybe eventually you're going to master yourself, but once they start to see a sudden run in price, they always feel like you're missing out. And that's one of the biggest, and this is how the market usually gets retail, and how the market usually engineers liquidity. Create one sudden move, I call this the smoke screen, right? The market will create a sudden move in one direction, even though it knows it was going to the opposing direction, and by creating a sudden move in one direction, that sucks in retail, because they FOMO in, right? They are not professionals, okay? And that sucks in retail, and retail creates a pooling of buy-side liquidity on the opposing side of the range, because they are all chasing the same move, which is shorts from the Asian opening range. And at the same time, anyone who's going long, they're constantly being tagged out. So weaker long orders are being neutralized as shorts are being induced with that initial decline lower. All right, so, and what we're looking for is we're looking for that decline. We want to decline below the Asian range, below to be a run into a M15 discount. In the brackets, ideally inside a daily or H4 discount area. Alright, so again, it's not really necessary, but we want to see the run lower from the Asian range to be a run down into a lower time frame discount, and that lower time frame discount should be in alignment with an higher time frame discount like an H4 discount or a daily discount, and then that will be a very high odd, high probability setup for us for execution. Right, and then what we're looking for is we're expecting price to quickly trade higher away from the 15-minute discount rate, because the market will run slowly. A lot of times, sometimes it could be sudden, but once it gets down to our level, we want to see quick displacement. So what we're looking for is look for institutional sponsorship as soon as we hit our discount. All right, and what's institutional sponsorship? You're looking for displacement. As the market goes down there, you don't want to see slow displacement. You're looking for fast, aggressive displacement, which is an indication of smart money participation in price at a key level. Okay, and the longer price stays around the 15-minute time frame discount rate, the odds of long setup drops. Why? Remember the analogy of the elephant stepping in the pool. When an elephant steps in the pool, there's always a ripple. The water in the pool is going to rise. And then as the elephant steps even more into the pool with the second leg, then its hind legs, the water displaces. And that's the same thing with smart money in price action. You can know the participation of smart money by the measure of displacement away from a key level. So if you identify a key level and there's a lack of displacement, that significantly reduces the odds. And you've heard them multiple times, especially in the live session, say, all right, say with your here again, that reduces the odds of probability. I don't want to see this happen. And you can also see the outcome from that, and this is where the logic comes from, right? If we want to trade in sync with smart money, then we want to see quick, fast, and dynamic price swings in direction of our execution. If we fail to see that, most likely we're not on side with price action, and we're most likely offside with price action, and that significantly reduces the odds of our setup actually running up into our objective or our counterparty liquidity. All right, so the longer price stays around our 15-minute discount rate, the lesser the odds of probability. And lastly, the short-term market structure sentiment will be most bearish at the time we enter our trades. Okay, and the rule here is buy when retail is extreme short. Okay, that essentially means buy when it is very fearful to buy. Okay, when it looks like it's the worst time to buy and the market is screaming aggressively against your direction, that's when you should be buying. Why? Because a lot of people are going to chase that sentiment. And one of the key things you want to do in this business is you always want to do contrary to what everyone else is doing, because everyone else is losing money. Everyone else, you're not making money. You also want to trade against what everyone else is doing. Okay, so you want to be buying while retail is net short, aka when it looks like the market is going to freaking tank, just before it looks like it's about to freaking tank. That's when you should be buying, because that's where you see a very quick reversal that catches everyone else off guard, and you already know the move while everyone's scrambling to try to switch sentiment and chase the longs. And by the time you're looking to chase the longs, the trainers already left them. but you caught the trend because you were buying while they were all bearish. And I'm going to show you live examples using GBP Okay, so you can see this price action today. So what we're going to do here is we're going to identify the start of Asian session, the start of, or the end of Asian session, and we're going to identify intraday open here. So that is intraday open. Let's look for the start of London session, the end of London session, start of New York, and the end of New York session. Now, during Asia, you can see a lack of real displacement price. We have a small little consolidation during Asian session. And if you use your standard deviations, again, you can also use standard deviations for Asia. You can see the classic or typical one standard deviation for the low of the day in a bullish order flow. That's what you get. And you can see your classic or typical 5 standard deviation for a very strongly trending market is where the high of the day actually forms here. Now, we're not really concerned with utilizing standard deviations for the lows or high intraday. We're more concerned with the nature of delivery going into London session. All right, now let me use the replay tool from here. Okay. Actually, let me go back a little bit. So just before London session starts. All right, so at this time, this is Asia. We have Asian session here. Let's look for our discount array. If we can identify any kind of item from discount, and we can, and that is this bullshit block high here. The eye of that bullshit block is our discount that we can identify so far. Okay, so we have that bullshit block there as a discount. Let's go down to a far time frame and see what the narrative is. All right, so on the far time frame, we have this turning point here. Market slams down hard into bullshit block, sees displacement, and then we have a low here. This is a far low here. All right, the market runs through that far low. This is a break block. So you have your a break block plus an inefficiency or fair value gap. Then the market displaces higher. Then the market now is returned back down into a bullish order block. What bullish order block? This was the candle that started all the run higher. So we're gonna also draw out the bullish order block for the 4-hour time frame. And then we're gonna go down to a 1-hour time frame to see if there's anything we can refine really for our high odds discount low, and there really is nothing. And then we're gonna go down into a 15-minute time frame. Now remember, this is a daily level. This is a 4-hour level. Okay, and what we can see from a daily time frame is that all of this consolidation originates from this swing low here. Now, what is resting around that swing low? It's resting around here. We have an inefficiency down here, and then we also have this last down candle prior to the Swiss line. But we're more concerned with the inefficiency. All right, so we have a 4-hour discount here, bullshit block, the body of that. Actually, let's also identify the mean threshold. Okay, so the mean threshold is going to be here, this one. Okay, so mean threshold of the FAR bullshit block, and then the actual FAR bullshit block itself. All right, so now if we go down to a lower time frame, you can see during Asian session, at this time, the market looks very bearish because we have run above the eyes, we have retail, classic retail resistance. We're seeing affiliates want to run higher in price, and we have support here that the market should be reaching for. According to retail, and then as we're heading to London session, look at the speed. As soon as we start during London session, look at the speed. So if you're up and you're going into London session, you're already seeing it yourself. This is very clearly bearish, right? Because between Asia and now, I've seen around a 13 pip decline for JPCHF. Now take note that JPCHF does not move a ton of pips. Okay, so we've seen this significant decline so far in price, and then we are more likely to be bearish, and retail will chase the sells because you're going to chase the shorts. Now, when should you be going long? As soon as we trade down into, look at the opening price from London session, as soon as we trade down into that discount already, which is that 15-minute inefficiency, coupled with, actually we can even narrow this down to a 5-minute inefficiency here. Okay, so that's a 5-minute fair value gap here. Market trades down into this once, again, and again, because we're in a consolidation. Okay, so we can buy at the inefficiency down there, and we could put our stops. Like what I taught you, you could put your stops either below this low here and allow yourself to get around below that low there, and that works. And then you can aim for some premium array. Okay, so classically you want to aim for the eyes up here, but you can aim for some premium. Now watch this. Now the market has triggered your entry, and at this point it looks very scary because now you think, well, what if I'm wrong? Because the market is very clearly bearish, and there's no indication that it's going to turn and be bullish. Remember what I just talked about engineering sentiment. By doing this, we are creating a pooling of liquidity on the buy side as everyone else is chasing this decline lower. Because now everyone is scared to go in and go long in the face of a very bearish JPCHF. And you get a sudden expansion for liquidity. And that was your chance to take some partials off. Okay? Now, again, because it's London session and daily order flow is bullish, you're looking for a daily bullish closure. So meaning you want to see the market close above the opening price for that daily candle. All right, so now we start to return back lower. And what do you think everyone is doing up here? They are buying the run above this high, right? As soon as the market expands up like this, they're rushing to want to buy. Meanwhile, all the individuals who are short inside of this, look how quickly the market runs above their stops. And then the market trades higher, acts like it's found support, because the research is going to look at this low as support, and this one, and this one, and this one. So you're going to think, okay, this bounce here, that's a good area to buy. Nope. The market runs deeper and clears out sell stop. Why is it clearing out sell stop? Because there are individuals who chase this long up here and also are buying what they think is support. And this is all coming in between London session. Okay? Remember I said the first 1 or 2 hours of London session is classically where you're going to see the manipulation play. Okay? This is, oh, come on. So I was into London session, and you can see the manipulation play again. And then the market starts to, and look at what I talked about with institution sponsorship. If you're on side with the institutions, the market will prove to you with a very clear displacement, not the slow, meandering price action. It's going to be fast. And I was also saying something about the previous day's context in terms of using that to understand the delivery for price. If you notice, in a weekly bullish anticipation, not every daily candle is going to be bullish. Some daily candles are going to create small ranges or potentially what I call retracement ranges. If the previous range, the previous daily range was a small range, then there's a very strong chance that the daily range you're trading is going to be a large range. And what's the reason for this? It is because small ranges begets large ranges, aka consolidation begets expansion. So whenever you see a small daily range, you know that is going to precede expansion. So you can use that to know days where you can expect a ton of pips, aka you're looking for a classic 4 to 5 standard deviation for day trades versus your classic 2 to 3 standard deviation for smaller data ranges. All right, so I'm going to end the video here and I'll do a part 2 to this lesson. I'll see you on the next lesson. Trade safe.